Hello and welcome. My name is Cathy Curtis. I'm the founder of Curtis Financial Planning, an RIA that focuses on women clientele for the past 20 years. My firm's mission is to support women in realizing their full financial potential. I am pleased to introduce this Women's History Month event with 4 female leaders in the investment management industry for a conversation about their path to success and insights into building a career in finance. These women have distinguished themselves through their longevity in the industry, their deep expertise, and their entrepreneurial spirit, and their insights are sure to inspire. Just want to let the audience know that feel free to pose questions in the chat, and we will get to them towards the end of the discussion. So to start, I'd like each of the panelists to introduce themselves. Nancy, want to start?
Hello, everyone. It's great to be here today to celebrate together. I'm Nancy Davis. I'm the founder of Quadratic Capital. I started the firm almost a decade ago in 2013.
Thanks. Katie?
Hi, everyone. Thanks for joining us today. Happy St. Patrick's Day. My name is Katie Stockton, and I founded my firm Fairlead Strategies in 2018. We are an independent research provider of technical analysis, so we have a very specific discipline, and also we manage an ETF called the Fairlead Tactical Sector ETF.
Thanks, Katie. Julie?
Hi, everyone. I'm Julie Kane, CEO of Democracy Investments, which I co-founded with my 2 partners almost 3 years ago now. Yeah, really excited to be here with some of my favorite women in this industry.
Great. And lastly, Katrina.
Hi, I'm Katrina Dudley. I'm with Franklin Templeton Investments. I'm a portfolio manager and investment strategist there, and I'm here as the author of Undiversified, the big gender short in investment management.
Great, thank you all. So we're going to start by discussing Katrina's book, and then which is going to lay the groundwork for the discussion. And then we're going to go talk to each individual portfolio manager about their career and their strategy. So Katrina, co-author of Undiversified, the big gender short in investment management. The book was inspired by the fact that despite decades of effort, the percentage of female portfolio managers, it's about 10%, and at the ownership level, even less than 1%, has remained persistently low. Through the research, she sought to understand the underlying factors contributing to this disparity and to try and develop solutions to attract more women to a career that she loves and is passionate about. So, Katrina, your book raises an interesting premise that the homogeneous nature of the workforce in active management may be hindering the industry's ability to consistently generate returns in excess of the market. However, you also mention a roadblock to achieving greater diversity on investment teams known as the 30% hurdle. Can you elaborate on this hurdle?
Yeah, well, you identified something. I mean, we were all taught that Portfolio Management 101 is all about diversification. So we have all got very diversified portfolios in equities, in fixed income, but we do not have diversified portfolio managers. So, there's that inconsistency there, which the book really focuses on. I think what we talk about where you have this low representation of women and we are looking to increase the representation of women, one of the things that we found, and it was a surprising aspect of our research, is when you add diversity to a homogeneous team, the performance of the team initially declines. And that was a real surprise to us because we always had been talking about the benefits of having a diverse team. And what happens is that when you add that first diverse member to the group, you need to change the norms of how you communicate. If you've got 5 white men from Princeton who have hung out together their entire careers, they kind of know how to talk to each other and they're experienced. And if you add a female to that to that world and that universe, they've got to change how they do that. And that's where the performance gap starts. But the good news is that once you get to that 30% level, what happens is the salient minority effect, which is when you're below that level, becomes like the acknowledged or the heard voice in the room. So you have the benefits of diversity. And from investment management perspective, that's great because more diversity leads to better decision making, and better decision making for us leads to better returns and results for our clients. So that's why we advocate, the real key here is not just getting diversity in the room, it's getting over that 30% hurdle.
Right. Can you discuss how the investment management industry compares to other industries? Like you mentioned, medical and law in the book, in terms of diversity, and just talk about some of the similarities and differences there.
We can give you statistics all day, every day. For example, over 60% of the employees in accounting and auditing firms are female. Now, if you look at that, that would align with over the 14% of analysts in the investment management world that are female. But in both sectors, which are consulting and leadership oriented, they have similarity in their skills. And I can speak from experience because I came from that world into investment management. About 20% of audit and accounting firm partners are female, and that compares to just the 10% that we talk about in investment management. And so you also have what we call this drop off, and that is a function of the promotion delay. And this promotion delay, we talk about, Salesforce.com was the one, and maybe they're not the best example now, but they're the ones that analyze the data. And they say that it takes about 12 months longer for a female to get a promotion than a male does. And if you look at the McKinsey work, that delay occurs from the very first rung. So the first rung of the ladder is broken, and that just keeps going up. And it's like it's harder and harder for women to climb that corporate ladder. In investment management, in accounting, we've seen it in law firms as well, because that promotion delay exists, and there are these hidden barriers to the ability for women to get into these leadership positions.
Yeah, and you also talk about work-life balance. Like I was struck by the medical industry, where you mentioned that women can be in specialties like pediatrics or dermatology and have wonderful careers and also have good work-life balance. But for some reason, that's not really possible in the investment management industry, although you could be a specialist in IM too. Can you speak to that?
Yeah, so let's just talk, but when we talked about the medical industry, we talked about the fact that, there's actually diversity in the number of candidates that are entering into the medical profession. So they've really fixed even the entry pipeline. But what we found in the medical profession is that women were over-indexing to the pediatrics, and they're the lower paying aspects of the field, and men were over-indexing to surgery. Now, even within surgery, we've seen progress with females. I think they're just over 20% of surgeons. So they actually have done a better job than we have with our 10%, but we wanted to highlight that disparity. In terms of work-life balance, I want to acknowledge the challenge that everyone here on this call probably faces of balancing things. But balance is a personal choice. And while I acknowledge that need to balance, and we always find balancing hard, I want to debunk the myth that it is work-life balance that is the reason that women haven't succeeded in investment management in particular. We interviewed over 100 people for the book, and at least 50 of those were successful portfolio managers, and not one of them mentioned work-life balance as being a barrier to their progression. So I think that the myth is there, and we really want to debunk the myth without, not paying attention to the fact that I think everybody struggles with work-life balance, men and women alike. I think women, it's been a focus area, and so that's why we think the myth has been perpetuated.
Okay, talking about barriers, this idea that you can't be what you can't see. So there aren't, 10% is not a big percentage. And so women don't have these role models to look up to when they think about coming into this industry. How do you see, what solutions can there be to that issue?
May I just actually thank all of the fellow guests on this call, including yourself, Cathy, because you are part of the solution, and doing things like this is part of the solution. Because, females who are in undergraduate in particular can see all these successful women at the top of their careers. And as you can say, they can see that they can get there. But the reason we are so focused on that is we surveyed undergraduates across 10 different universities across the United States. We partnered with Rutgers in doing that research, and we combined doing survey work with in-depth interviews. And what we found is exactly that they didn't see visible role models, and therefore these young students, and particularly female students, were not applying for jobs in finance. And we know that if they don't apply for a job in finance, we can't recruit them. If we can't recruit them into finance, we can't retain them. And if we can't retain them, we can't promote them. And if we can't promote females, we're not going to have female leaders at the top. So we get stuck on this flywheel. And when we talk about the solutions, we're really looking at that entire supply chain into the investment management industry. And what can we do as an industry, all of us, not just the women, but the men as well, to increase the pipeline and the supply of women in investment management.
Okay, so this brings up another issue, and that is the negative perception of the industry. Even though all these efforts by leaders like you to bring women in, this thing persists. The Gordon Gekko, and now you've got Billions, and these characters that aren't exactly admirable. Why is that so hard to shake?
Look, Hollywood has not been a friend to Wall Street, and it's not going. You don't even have to go back as far as the original Gordon Gekko to see examples of things. And these are the images that young women have. So think about The Big Short. They were doing research in strip clubs. I've been in this industry for well over 20 years, and I can tell you that's not acceptable, and it is way not the norm. But that's the image that Hollywood has perpetuated. And when you say, why is image so important? The fact is that we have a bad image as finance. We get a gold medal that I'm not proud of, and that is we are perceived as the worst place to work. The worst. I mean, that takes a lot of effort to be the worst. And why do we have that perception? Well, it's the movies, but it's also the images that you see of, the foreclosure of your next door neighbor's house, or the activist who is targeting Starbucks, but for the average person on the street, they're targeting the barista who knows their favorite drink and has it ready for them each morning. So, that's the perception. And if you look at how that perception and that negative perception feeds into the recruitment issue, the research has come out of Germany, but they found that at the university level, women will not work for a bad company or a bad industry, regardless of what you pay them. Men, if you pay them enough money, they'll go and work for you. And so this fact that we need to rehabilitate our image is really important. And if I had the CEOs of all the finance companies in a room together, that is one thing that collectively they need to do.
Mm-hmm. Great segue to my next question, which is the compensation models in the industry. Women want to get paid in different ways, it seems. And you talked about the piece rate versus fixed rate compensation. Women prefer a salary and not the big giant bonus, or, a different ratio there. Can you talk to that?
Yeah, so our compensation model has a bonus, a significant bonus element to it. If I look at financial advisory, it's much often, a commission type arrangement, and those things are analogous to like the piece rate in a production facility where the research has been done. And if you offer women a piece rate versus a fixed salary, they will take the certainty of the fixed salary over the more variable commission rate. It's just their nature. So what we're talking about is the way we've structured compensation. It may align with various things, but unfortunately, it doesn't align with the needs of women. And you talk about the financial advisory model, and often you start small with that commission base sometimes, and you need to build it over time. And women are often not comfortable with that, having that delay in building. Part of that also comes down to often their family structure, or the fact that they may be the only breadwinner in a family household, and they cannot weather that initial lack of income. So I think that we need to collectively come up with a solution which will attract more women into advisory, into our profession as well. And I think we've identified one of the barriers. The other barrier, and I'd like to address this, is what we call the 3 Ps. So females are paid less for the same position as their male counterparts. They get lower performance ratings for the same objective level of performance. And we've also talked about that promotion delay. So we are challenging the investment management and any other finance industry that analyzes data for a living to turn the lens inward and start analyzing their own data and think of ways that they can address these 3 big gaps that exist and equalize the Ps. And let's be clear, we're not talking about surpassing it, we're talking about equal treatment.
Okay, well, Katrina, thank you so much, and thank you for writing this book. I can't help but think it's going to move the needle, and now you've set the stage perfectly to talk to our 3 female leaders about their specific careers. So thank you.
Thank you.
All right, let's start with Nancy. So as a reminder, Nancy Davis is founder of Quadratic Capital Management, and she's an expert on derivatives trading and risk management. So Nancy, reflecting on your 25-year career, including 9 years at Goldman Sachs, what specific experiences and challenges have had the greatest impact on shaping you into the leader you are today?
Well, I think, I had a wonderful training ground. I was with Goldman's prop desk. Those don't really exist anymore, but it was a great time and a great learning environment. I think having, diversity of whether it's gender or socioeconomic or neurodiversity or nationality or ethnicity, those are all, I think, important aspects. But I do think at the end of the day, you want diversity within your portfolio. And I think a lot of the asset management industry is the same old thing with different wrappers around it. And I think that's one thing I've really loved about being on the Goldman prop desk, was really looking at a different way of constructing portfolios, a different way of managing risk. Most portfolio managers would use stop losses, which I've always, you hear about it all the time in risk management, where people are like, oh, we have tight stop losses. And I think that was one thing I learned and carried forward and really built my career on, is a different way of risk managing. And instead of creating a portfolio and then risk managing it, we do that. What I did at Goldman, what I do now, all through the use of long options, because you can structure the portfolio so you know how much you can lose, and then you can risk manage when you take profits. And so it has a very different profile, because you're kind of, buying low and selling high to risk manage, whereas most kind of, I'd say, traditional risk management is with stop losses, which, if you just take a 1,000 step back, you think about it, it means first that portfolio manager loses your money, right? That happens first. And then only afterwards do they manage the risk. And they do that by selling the things that they like to own at a loss or covering the things that they like to short at a gain. So I think that was one of the real key points in my career, was thinking different ways of implementing portfolio risk.
Do you think that your gender has anything to do with how you looked at risk differently?
I don't. I mean, it's interesting because I was hearing Katrina's opening comments, and I've not read your book. I'm very curious. I'll check it out. But I know for me, I felt thrilled to be a trader at Goldman and a portfolio manager. And I feel like it's actually the ultimate meritocracy. I guess it's like all sort of how you look at things. But I was promoted to be the head of trading, all credit derivatives and OTC trading in my mid-20s. And I felt like I had a tremendous amount of opportunity, at least within my group and my experiences, where I was always treated fairly. And I don't think it really impacted me whether I was a woman or not a woman. I think it was more, it was a very flat organization. It was, pretty simple. You either made money and you were promoted, or you lost money and you were fired. And it was pretty quick to figure out, where you were. So I don't know. I guess I've had, everybody's journey is different. And I think it's hard with generalizations to say, oh, you're a woman or you're a man. I think so much of it is also your upbringing, your culture, your training, even, your socioeconomic, your neurodiversity. Like I think I have, I've definitely been a weird kid all my life, whether I'm a man or a woman, it's, irrelevant. But I do think I think about things in a different way. And I think my neurodiversity is probably what's really helped me the most in my career. Or you could say, I don't do things like everybody else. And I don't know if that's because of my gender or because of something else, but I don't know. I have a hard time with generalizations, because I do feel like I was given, personally speaking, I'm not talking about everybody, but from my experience, I feel like I had a tremendous amount of opportunity, and my gender didn't negatively impact me at all.
Okay. So let's turn and focus on your ETF strategy, IVOL, which is the interest rate volatility and inflation hedge ETF. So you built this strategy. Can you explain it, and also how it may integrate into a portfolio?
Sure. So I started my career at Goldman in the late 90s, right when the US Treasury created they're called TIPS, which are Treasury Inflation Protected Securities. That's what the acronym is, TIPS. I always had sort of a, problem with those instruments, because they're bonds and they all will lose money based on their duration exposure because they're bonds. And number two, the only index to measure inflation is the consumer price index. And that's always been sort of that I'm like, nobody, like if you think about the equity world, nobody would buy the Russell or the NASDAQ or the Dow Jones or the S&P and say, ta-da, I have the equity market. It seems kind of weird to do that with something bigger and harder to measure like inflation. So I'd say it's been, a career-long passion of mine to try to fix the problems that exist with TIPS alone. So we take a TIPS portfolio. IVOL owns a lot of TIPS. We have about 80% of the fund in that type of treasury bond. But then we try to fix the issues that are there, which are the duration problem and adding another measure of inflation besides CPI. So it's a pretty different. I would say it's not, it's not a lot of people are not kind of implementing this strategy, but I do think it's a very practical way to think about looking at the market. And I think that's one nice thing about it, is it doesn't really behave like everything else, because it's kind of pretty different, right? We've had very low correlations historically to other asset classes. And I think that's where I go back to, I don't know if it's my gender, but I do think I think about things differently. And I think that's good when you're thinking about a portfolio. You want to have a lot of different things, because at the end of the day, diversification is all about not having everything go down together. So it doesn't mean, all investing involves risk and not everything is going to make money, all the time. You can definitely have everything can lose money, but I think having things that don't look like everything else can be a real positive.
So given the volatility in interest rates right now and inflation and all, how has your strategy been working, particularly in the last couple of months?
We've had a couple of nice write-ups within the last week, with Silicon Valley blowing up, unfortunately, where that was it's always short volatility that blows up every single financial crisis. It's the same thing. It's just, different actors who get blown up, whether it's the savings and loans or the financial crisis. And I try to emphasize that to people that, any place that they have financial mortgages inside their bond portfolio, owner of a financial mortgage is short options to homeowners. And whenever you're short options, you're short vol. So we were written up, I don't know if this is factual, I'm just quoting the article, but as the best performing fixed income ETF strategy during the Silicon Valley Bank crisis, because we've had very decent performance recently, but that's because it also owns volatility. So it's not equity vol, it's rate vol. So again, it's just something different. But I think most regular people have that implicit fixed income vol short, because a lot of the benchmarks own, like the ag index, a third of it is mortgages. And any place you have US mortgages, homeowners are long the option to prepay. So very simply, most people are short vol in their bond portfolio. And that's what happened to Silicon Valley Bank, is they had a lot of mortgage risk. When interest rates went higher, homeowners did not prepay as quickly as they had modeled, which extended their duration and caused more losses to their investments because of yields going higher. So all bonds lose money when yields go higher. Even, it's one of my pet peeves in the industry, is the concept of short duration. I feel like it's a little bit of a fake name, because it's not actually short anything. It really should be called less long. It's all long duration. So
great. Well, thank you, Nancy. You're obviously an expert in this area that many of us are not. Okay, we're going to move on to Katie. So Katie is the founder of Fairfield Strategies and an expert on technical analysis. And Katie's had a 20-year career doing this technical analysis. And so, Katie, can you share your experiences and what shaped you to start your own firm?
Yeah, of course. Technical analysis is a discipline that when I got into it, it was about 25 years ago in the late 90s. When I got into it, it wasn't terribly popular, to be honest. So it was a unique field to choose straight out of college. And I had the opportunity in college to be exposed to the discipline in just a way that I felt lucky. I already had that sort of track in terms of studying finance in undergraduate business school. So I had that interest in investing. And yet I just had the fortunate situation where I had an internship, and that internship led me into another one that was really solely doing technical research. But over the course of my career, with that discipline being sort of lesser known, what I found is that when I was going through transitions, it was a very unique position to be in, where you never would see a job listing for a technical analyst. And even to this day, you really don't. So that presents, of course, a challenge for anybody who is practicing it as a professional, which I was really from day one. So when, ultimately the transitions came, my first of which was really through the sort of bear market cycle when the bubble burst. I was in San Francisco and sort of living it up, right? And then it very quickly felt much different. in that transition, we had to adapt and be creative. And I think what we're all taught when we're young is that you sort of grow from adversity. And as much as there's far worse adversity out there in the world, that adversity definitely, I think, helped shape who I am now as a professional and practicing technical analyst. So, my resume may look a little bit dotted and, creative, but that was my way to get to where I am today. I found myself in my mid-20s starting a consulting firm just so I could work as a technical analyst in a situation that was less than ideal, where I didn't have health insurance. I was acting as an independent contractor. So I think it's that sort of adaptive approach to my career that helped build my resiliency through all different sort of environments, both, sort of career related and also even market related. Now, 25 years in or so, we've lived through quite a few different types of market cycles. And there too, you learn from those cycles. And I actually was saying to one of my analysts who's quite young, I said, I'm kind of glad that we have a bear market cycle this early in your career for you to experience, because it's really a valuable experience to have when you then, sort of come out of it and then know what to identify in this type of different environment, which is over history, again, not that common. We don't have a huge sample size of bear markets and equities. I tend to be equity centric. So I think it's been, I guess, a great sort of learning environment, as difficult as it is for us all to sort of navigate in terms of our portfolios. But over the course of my career, I think, like all of us, and I know Katrina has some good color in her book about mentors and sponsors. In terms of mentors, I was very fortunate to work for, and they were all men for the most part, but they taught me so much. And I think that's really what shaped my methodology. So by that, I mean how I approach the markets. Sort of the basis of my technical analysis was largely sort of shaped by these mentors who helped me with my craft. And, I would take a couple of technical indicators that really sort of suited the way my mind worked, and ultimately came up with something that's very much sort of unique to me. So I value that mentorship that I had over the course of my career. I feel I grew from the transition phases and having to be creative to continually practice technical analysis in different capacities.
Great. So you talked about being unique to you, and are you referring to your ETF strategy TAC?
Well, in part. So yeah, as an independent research provider, so TAC, TACK is the ETF's ticker. And that's intentional, of course. It is tactical. I always say tactical is sort of a euphemism for technical. And it is dynamic, but I'd say even more than that, suitable to what I do for my daily research, is that it's systematic. And I think that's the great benefit in using technical analysis, is in a systematic approach. So that systematic approach is indeed something that developed and became sort of increasingly important to me over the course of my career, having seen the benefits of it. And primarily that was through my research, which ultimately then became sort of the basis for tax strategy. So we have sort of a suite of technical indicators that we use to inform our biases. And by that, I mean, we're trying to assert sort of a directional bias over multiple timeframes, and by identifying prevailing trends, also by identifying momentum characteristics, and with metrics in terms of how overextended or sort of overbought or oversold something might be. And all of those taken together can be very informational and provide you a mathematical and sort of objective takeaway about a market that is often quite emotional and sometimes has a lot of gray area and a lot of noise. So these indicators I really welcome in the way I think about the world. I like to have that more binary sort of black and white outcome. And that's what I think the systematic approach affords. And also the technical indicators, which are all mathematically mathematically based affords. So when we say something is overbought, it's not just a feeling we have, it's actually a mathematical formula that is telling us that it is overextended perhaps. So we've taken this combination of technical indicators that we have and developed it into a model, which of course then has not just the technical sort of elements to it, but also attention to risk management, which I think we've seen is already a theme here in our conversation. Risk management being absolutely key just to portfolio construction. So that became, sort of something that I had to go up the learning curve with that. And I found that the best way to do that was really through asset allocation. So we, at first, with our technical model, we're trying to identify in the US equity market the best sectors. And by that, I mean sectors that have the strongest upside momentum over a long-term time frame, and also the strongest relative performance versus market benchmarks like the S&P 500. So that's what we're first sort of charged with our model. But when the market's doing what it's doing now, and it's not really lending itself to those nice solid uptrends that have good momentum, well, then we found it best to move into other asset classes, to sort of take a step back from equities and try to find sources of relative performance, and to do that in a diversified manner. That diversification is, to us, kind of what saves you from, years like last year, which surprised a lot of folks in terms of the long-term treasury bear market, where they had previously perhaps moved almost solely into that side of things, where they would have been well served to have diversified that sort of allocation to things like gold, which is one of our positions in this type of environment. So we have positions, or the ability to position, in long-term treasuries, short-term treasuries, and gold when we don't have the sectors to fill those buckets in our portfolio.
Okay. You are well known for your work on the anatomy of a bottom. Can you describe what that is?
Oh, yeah. So listen, and it's become so relevant of late. I think that what we've noticed in the bull markets that have dominated our careers is that the bottoms tend to occur in somewhat a V fashion. So if you can picture a V, that's usually how a corrective phase unfolds. The market will emerge from those corrective phase pretty quickly and often forcefully. But that's not often the case in terms of advancing from a bear market cycle. We call it a bottoming process that is usually required, and we emphasize process there because with bottoming, you do see an initial sort of major low, but then you also often see a series of retests, and by that we mean a rally and then a sort of a retracement back to that level or near that level. And in doing so, the market sort of restores confidence, and you start to see divergences, things that are saying, okay, well, on each of these retests, perhaps the momentum is getting a little bit better or less bad, let's put it that way. So it's that process that we are trying to identify, and trying to just essentially not be ultra predictive in our work, but trying to stay on the right side of the market, trying to make sure that we're following the prevailing trends, managing risk appropriately, and acting on catalysts, technical catalysts, that is, when we see them. We believe that a top-down approach is really very valuable, especially in this type of environment where, unfortunately, folks aren't being rewarded necessarily for stock picking. So, when you have such a macro focus on the part of investors, you're really very well served by having these sort of trend following tools on your side as it pertains to the major indices and the breadth of indicators that you can look at around the world.
Great. One last question for you, and this is in regards to your career at CNBC. You're a media star, and I could see why with your expertise. And how is this experience impacting your work? And do you have advice for other professionals if they want to get into media?
Yeah, I joined as a CNBC contributor, so they it sort of invited me to be a regular contributor to their network. And my discipline is obviously very specific. And what's wonderful about it is that anything that has a price, I can have an opinion on. And so I can talk about just about anything, including cryptocurrencies for one. So that sort of, I guess, diversity in what I can address, and often without, sort of more in real time, I think makes it an appealing discipline, and something that you do often hear a lot about in the financial news sort of media. You hear a lot of technical analysis because it helps sort of paint the picture of what's happening in the markets, and it can do so even over very short-term timeframes. So it kind of fills the blanks or fills the gap where either maybe there's not news to explain something, but what can explain something is sort of market psychology and the behavioral elements that drive these trends. So I think that's sort of the general appeal of technical analysis. It helps people navigate these swings and sort of, wade through all of the noise and all of the headlines. Any kind of media exposure we feel like helps keep us and our exchange traded product and also our research product somewhat front of mind. And, we always hear about thought leadership. I think if you can try to, have thought leadership within your discipline or around your methodology, I think that's always a good thing, to be able to communicate, and to communicate not just in times where things are working and supporting what you're doing, but to be there and communicating when things are going against you, because they will do that. And so I think that consistency in communicating and being vocal when it's appropriate to be vocal, I think that really sort of gets some professional respect and serves as a nice platform for what we're doing, which is also very visual. As a technical analyst, we're looking at charts, and you can certainly program a lot of it. You can make certain things about it quantitative, but at the end of the day, there's really no replacement for simply looking at a chart. So it's a very visual sort of discipline that we have, and that lends itself very well to the media.
Great. Thank you so much, Katie, for everything you're doing. Next, Julie. Julie Kane is a managing partner and CEO of Democracy Investments, and also was the impetus for putting together this panel. So thanks so much, Julie. I'm going to ask you the same question. Looking back over your 30-year career, which included time at SEI, Wells Fargo, Schwab, and now Democracy Investment, what experiences helped shape you in your career?
Well, reflecting on this whole conversation, I'm actually remembering that I started at an all-girls high school where I was surrounded by young leadership, young female leadership at a very early age. I went from there to ROTC at UVA. My way of rebelling was to join the Navy. And suddenly I was in an ROTC unit that was mostly men, and then went into the Navy to fly helicopters, which was also, there were very, very few women at that time ahead of me. But I had a ton of, just like everybody else here, I had great male mentors and sponsors. Katrina's talk about the 3 Ps, I'm realizing I was very lucky. I got paid exactly the same. You're paid by your rank. The metrics were, you landed it right or you didn't. It was very black and white performance metrics. And the diversity of thought that in that experience also came from the importance of get from the bottom up. So starting at the lowest ranks, as if I would start my day, I was in operations, and I would start my day getting a coffee with the maintenance team, making sure, what's going to happen today. And I think I brought that bottom up strategy into the corporate world with humility and realizing the importance of collaboration, which many corporate cultures were more top down. So I enjoyed good success with that style that I learned at a very early age. And I was stationed in the Philippines. So at a very early age, I was recognizing how lucky we are to live in a democracy. And I kept that passion with me, and later in life became more concerned about the trends in democracy. And I just feel really fortunate that at this time in my life, I feel like everything I've ever done is coming into play with what I do every day.
Great. You're a risk taker for sure. Flying a helicopter, right? Not easy to learn.
Yeah, adrenaline junkie. Now I mountain bike.
So tell us about your ETF strategy, which is the Democracy International Fund.
So our strategy is we start with an all-world ex-US index. So very similar to ACWX, VEU, CWI. What they track the MSCI and FTSE all-world ex-US indices. We use Selective. But the difference is we tilt the portfolio very neutrally and systematically towards democracies and away from authoritarians, leveraging the Economist Democracy Index. So we're not deciding the tilts. We're very neutrally applying what we think is the best measure of democracy in the world. The Economist has been tracking country democracy scores since 2006, a very robust methodology. And that results in it's overweights to the UK, Australia, Canada, Japan, and we underweight China, Saudi Arabia, Egypt, etc. So our strategy is to provide a very passive, systematic, international exposure for investors who want to support democracy and stop fueling the growth of authoritarian states.
I imagine right now you're outperforming the major international benchmarks. Is that correct?
Oh, we've had excellent feedback in that regard with as everything we're seeing with deglobalization, the shifting supply chains, the war in Ukraine. We saw a lot of media right after that. And yeah, we've been really pleased. Our strategy has turned out better than we expected when we launched. It'll be 2 years ago in 2 weeks.
Great. Can you talk a little bit how you construct the portfolio? Are you actually picking individual stocks, or how is the portfolio being built?
No, so the Democracy International Fund, ticker symbol DMCY, is we start with the same basket of stocks that are in an all-world ex-US index, and we just neutrally tilt into securities country of risk. So we have the same large cap, mid cap, and developed and emerging markets. But with our tilts, we're slightly more developed markets. And so we're not picking stocks, we're starting with the same basket and neutrally tilting according to the securities country of risk democracy score.
Okay. And if you were taught, I'm an investment advisor, I invest my clients' money. And if you were talking to me about your fund, where would you suggest I fit it in alongside a more typical foreign strategy? Or
yeah, so we're a clean lift and replace for your all world ex-US, your passive international exposure.
Okay, great. And your team and your firm, you have a couple of partners, and I know you're a great networker and you've built these relationships over years and years. And I think you're a good role model for other women looking into the industry, that is so important to have a good network. Can you talk about that a little bit?
Well, I guess the variety of my experiences, and I think I'm naturally extroverted, and I enjoy keeping in touch with everyone I've worked with. And you know, I'd like to reflect back on the mentors and sponsors that's been a theme here. Keeping track of your mentors and making time to mentor, very important. And I'm also reflecting that I had incredible sponsorship from men who either had sisters in the industry or daughters. That there tended to be a correlation there, I noticed. And I'd just like to share that ahead of time with folks on the line, and would love to hear shift gears into I think we're going to shift gears to the Q&A. Are there other questions you wanted to?
Yeah, no, I'm ready to do that. We have a good question lined up. And this would be for everybody. do the participants feel investment consultants are doing their part to identify and suggest clients allocate to female portfolio managers and asset managers owned and operated by women? What about gatekeepers at large wealth management platforms?
Maybe I can just start and address this, because I think that we've talked, Nancy mentioned some concepts of diversity, and I really align with those. Is we're not looking to shift diversity and swing the pendulum 100% the other way, because 100% female managed portfolio has the same lack of diversity as 100% male run portfolio. We're looking to have diversity in the portfolio managers, in the investment teams running those portfolios, and it's the diversity that brings about that better decision making. So I just wanted to be clear and make sure that the takeaway is that we want diversity in our portfolio management approach. We don't want one way or the other.
Would anyone else like to respond to that question?
Yeah, I can't say that I have a sort of a full swath of what's going on out there in terms of the investment consulting landscape. But I do think there's nice attention to female sort of portfolio managers. I think there is, and it seems to be growing. So I think it's a growing trend, and it may open a door that otherwise wouldn't be open. So I do feel like it is providing, some level of opportunity that may not have been there. There's a lot of fantastic organizations that are facilitating that type of sort of access in a way. Like 100 Women in Finance is one good example of that. They have ways to help sort of marry or sort of make introductions between these sort of the portfolio managers and the allocators. And so I think it's nice to see that support system there. There's always more to be done, but I think the trends are favorable.
Right.
Nancy. Yeah, I've seen all these emerging management programs out there that the pension funds are putting together, but I haven't seen large movements. And I feel like Katrina's book does a great job of capturing where we are today, having started in financial services so long ago. I'm just shocked that we haven't moved faster, that the numbers aren't changing as they should, given the more women in the industry.
I guess I would say I do see that. I agree with Julie that I don't think there is a lot of capital out there specifically for women or minority managers. I think it's more focused. There's been a huge amount of capital that's been drawn into the ESG label. And I think right now there's a lot of scrutiny on what defines ESG and what does it mean. And I think that is a huge opportunity for going back to the question from the audience about institutional consultants to be also looking at the S and the G component. And you can do that very easily in a quantitative way by looking at firms and their ownership and their leadership. And I think you could take the approach like Katrina mentioned, where you want diverse portfolio manager teams, or you could also say, look, we want firms that are maybe governed by women. Julie and Katie and I are all woman-owned firms, majority woman-owned firms, women portfolio managers. It's the G from governance. And it's also, sadly, I think they're way less, the big have gotten bigger since the financial crisis. And I think that's true whether you look at banks or asset management firms. And so the sad reality is that women and minorities manage less than 1% of the world's AUM. And so I think looking at women and minority owned firms from the social point of view could also be, I think with the ESG shakeup, it's a good opportunity for people to really say, look, we can look at the management structure, not just a lot of these ESG indices are very focused on stocks and publicly listed securities, and they're looking at the corporate boards, or they're looking at the internal rules for diversity and inclusion and all these other metrics. But I think looking at ADVs, in a systematic way is a very easy way to help flatten the curve and also provide, you know, more diversity across the portfolios. And I do think ESG can be any asset class. I think that's another important component. I think when you look at, there's been a lot of focus on the E part, but less on the S and the G.
Okay, we've got a few more questions coming in here. Women outnumber men in college enrollments, and that's been over the last few years. Do you think this means there'll be a sharp increase in women portfolio managers in the coming years? I mean, would there be a tipping point at some point where women will start coming into the industry? Katrina, do you want to start with that one?
The fact is that we're on this flywheel. So obviously, if you increase the number of women undergrads taking finance, we would hope that we would be able to recruit them, but we still need to perpetuate that model of having more senior female role models, because just taking finance at college level does not generate a recruitment into finance. You know, finance as a skill set is very broad based. It's a phenomenal set of skills, and it has applicability not just in investment management, in a multitude of industries.
Okay, a follow-up question is the lack of women undergrads in finances or specialization. Is there any impactful solutions that you have found to tackle this issue, that women are not choosing finance as a career?
We need to start, it's just surprising to me how many of the investment clubs that are on campus and managing, money, like real money, are unsupervised. There's no adult in the room. There's no programmatic element associated with that. And the result is that you have a perpetuation of the bro culture that exists on Wall Street, perpetuating into those student investment clubs, and they're detracting women from joining them and getting the skill set early and being part of investment management. So I would say put a professor in the room, have that professor actively monitor the composition of the people in that room so that you have diversity, both gender diversity, socioeconomic diversity, and all lenses of diversity. And I think that that is step one. It's implementable, it's tangible, and I do think it'll make a difference.
Excellent. With respect to AI, do you think that women are well represented in the coding and AI area? Katie, you want to jump in on that?
I have no idea, but I would guess not. So I do think that there are certain fields that appeal to women more than men. And I don't know if there's sort of a nature versus nurture going on there. I know that in my undergraduate business school, there certainly was, when you're choosing your concentration, that's where you really saw the women dropped off in terms of finance and at times economics as well. They went more for the marketing fields or the accounting sort of concentration. So I think there does need to be sort of a concerted effort on the part of, the professors or the management to direct and inspire to make sure that there is, that young women know about these opportunities, and it does have to be a concerted effort. So I think that's difficult because it really has to start from the bottom up, and it often will take one or two sort of inspired professors to implement some change on that level. But boy, it really can go a long way. It just becomes, it begets more of the same, to Katrina's point of, well, you got to start somewhere, right? So once you have one woman start to go through, well, then you also had the benefit of the word of mouth from her to her friends to say, well, this is really actually super interesting. We have at my alma mater brought in a lot of guest lecturers who are diverse, and that I think is another way that young people can be inspired, or students can learn about different fields. They can learn about different ways to express their academic education, and they can do it in a way that almost they probably won't even really realize it's happening, but they say, well, gosh, if this person can do this, I can do this too. So I do think there's ways for all of us as professionals to sort of go back to our universities or go to a local university and even offer to sort of provide some insight to the young people there as a way to inspire them.
And Katie, you touch on something, and within the tech field, one of the barriers to getting more women there, because they do have a similar issue and a lack of diversity, is the presence of what we call the bro cultural artifacts. And I think when we went, and you and I were speaking at another event, we saw them very prevalent in the audience, and it's called the Patagonia bro vest. And so we need to just really deliberately eliminate these type of artifacts out of our culture and out of the companies. And I think if we start doing these small changes, think about that when you're thinking about hosting events. So let's take the events off the golf course, which typically skews into male, and put them into Soul Cycle, or put them into other venues, or put them into bowling alleys. There's a lot of other places that we can host events where there's equal welcoming of both genders, and there's and everyone feels like they're part of the culture. So I think that Katie has some really great suggestions doing it within bringing in professors. I think everyone here has great suggestions on how we can do it, and there's no one silver bullet, but there's a lot of things individually everyone here can do.
I love the inspiration for the end of this discussion. Thank you. Anyone else want to add an inspiring thought before we close out? Nancy?
I'd just like to say that I know a lot of people, I'm a big advocate for liberal arts education too. I think you can absolutely go into finance and make a career of it and be successful without majoring in finance or majoring in business. And I do think, I feel like there's so much pressure today on kids, whether they're, like when I was a kid, or probably when most of you were growing up, we did 3 or 4 sports. And now there's such this concentration with specializing so early. People are doing year-round sports and being forced into disciplines. And I do think there's a lot of benefits of having, especially as an undergrad, when you're experiencing college, to have a lot of different experiences and a lot of different things which help form that almost tapestry of who you become and how you think and how you problem solve. So I know when I was at Goldman and hiring people, we would have so many kids that they're plug and play. They were like born to be Wall Street, analysts. But I really also enjoyed hiring kids that were from diverse backgrounds with diverse backgrounds. And so I don't think you have to be a finance major or you have to be a business major to have a very fruitful career. And I think just like everything else, you want to have people with different backgrounds. And I think, so I would just stand on my little platform for those on the room to say, enjoy college, enjoy liberal arts. You can be, interested in any subject, but also have, no matter what you choose to do in your career, you can always, financial literacy it applies to everybody, right? You could be, in a totally different industry, but we all have, hopefully savings and need to have that financial literacy to protect our future. So I'm just a big liberal arts and keeping diversity. And I think it's just so much pressure on kids to specialize so early on and try to figure out what they want to do. I had no idea what I wanted to do when I was, 17, 18, 19, even after I graduated from college. So I think just enjoy yourself and figure out what you're passionate about. And I think whenever you find something that you really enjoy doing and you would do it in your spare time, that's a great place to make a career. And whether it's finance or not, we all need financial literacy.
Thank you so much, Nancy. And to all of you, Katie, Julie, Nancy, Katrina, what an excellent discussion. And happy St. Patrick's Day. And the recording will be shared. Follow Julie Kane's LinkedIn account or the Democracy International website to get a recording. And I hope you all enjoy the rest of your day. Thank you for the honor of moderating this panel.
Thank you so much.
Kathy. Thank you, Kathy. Thank you, Nancy. Thanks, everyone.
Thank you.